Today, we have announced the Group's results for the first half of 2024. We've made further progress in the first half and created momentum, which will carry through into the second half of the year. This has been achieved despite the challenges in the external market for new business, particularly in our business finance areas. Businesses and consumers continue to feel pressures, and the higher interest rate environment has impacted demand for credit as the Bank of England intended. We have remained agile in our approach to managing our balance sheet, ensuring good credit discipline and being selective on new business opportunities. As a result, we remain confident that we're on track to meet all our medium-term targets and expect to see further loan book growth in the second half of the year, taking us closer to our £4 billion net lending ambition. This will in turn drive profitability further forward. I'll now take you through some of the highlights of our performance for the first half. We've delivered a double-digit increase in our adjusted profit before tax pre-impairments to £45.2 million, which is up 12.4% on the same period in 2023. Adjusted profit before tax of £17.1 million was just below the same period last year, and we will explain why later. This has been driven in part by a 3.2% growth in our loan book to £3.4 billion, which now stands just £600 million away from our £4 billion target, which is the level at which we expect to deliver our key financial target of a return on average equity of 14 to 16%. Our lending growth has been supported by the generation of our record deposits, which were up 6% to £3 billion. Our net interest margin reduced to 5.3% from 5.4%, having been impacted by higher funding costs and the lag effect in asset repricing. It's been encouraging to see the rate of funding costs ease in the second quarter. Our exit rate on NIM for half one was 5.4%, and we expect full year NIM to be in line with market expectations. Equally important to lending growth is our continued focus on driving efficiency, and we've made great strides here during the first half of the year. Our adjusted cost-income ratio has improved by 220 basis points to 53.7%, despite inflationary pressures. Furthermore, we've increased our cost savings target for Project Fusion by £3 million to £8 million annualised savings at the end of 2025. Our risk-adjusted margin decreased in the first half of the year, driven by an increase in impairment charges, primarily due to a pause in our collections activity in vehicle finance following the FCA's Borrowers in Financial Difficulty review. These were somewhat offset by retail finance's arrears being low and stable. Our CET1 ratio of 12.7% remains well above our target of 12% and demonstrates that we have a healthy level of capital to fund our future growth. So overall, good progress in the first 6 months. We are confident that we remain on track to hit all of our medium-term targets and have seen our tangible book value per share increase by 3.1% to £18.36. Following our move to a progressive dividend policy earlier this year, the Board has approved an interim dividend of 11.3p per share. In addition to our financial performance, we also continued to make strategic progress guided by our Optimising for Growth priorities. These put a clear focus on simplifying the Group, enhancing customer experiences and leveraging our networks, and are central to delivery of our targets. Project Fusion is a driving force behind our focus on simplification and has been effective at driving cost efficiencies through supplier reviews and technological enhancements. Further opportunities have been identified in 2025, giving us greater confidence that we will drive our cost-income ratio to a 44 to 46% target. We've also made progress when it comes to enhancing the experience for our customers, again using technology where it adds real value. As a result, we've seen more and more customers using digital interfaces to self-serve while maintaining our high customer satisfaction levels. Again, there's more to come in half two, including enhancements to our savings mobile app. I've been really pleased how colleagues and teams have embraced the consumer duty and are continually making changes to improve outcomes for customers. And thirdly, we've continued to leverage our networks. Our success is built on the importance of relationships with our partners in each of our specialist lending businesses. For example, in our real estate finance division, we have seen new lending to existing clients increase from 36% in 2021 to 63% in the first half of this year, with reliance on new lending origination from brokers declining from 42% to 6% over the same period. Using technology to support each of these three strategic priorities continues to be a priority for us. We'll continue to invest in technology where it has the ability to drive growth and efficiency. The use of AI tools has also helped to drive efficiency in handling complaint volumes, and there's work going on to consider broader use cases for AI. I now want to give a quick overview of the progress within our business divisions, starting with consumer finance, where we've seen net lending grow by 7.3%. That's £122.9 million since the end of December last year. We've seen strong growth in lending and revenue within our retail finance division, which has come mainly from interest-free lending into the furniture and jewellery sectors. Record lending was achieved, with lending balances increasing 7.5% on December last year, and our market share is up to 17%, a new high. The net interest margin for retail finance increased by 0.3% compared to June 2023, and the cost of risk decreased to 0.7% over the same period, reflecting our continued focus on better quality customers in this business. Our vehicle finance business has also performed strongly, notwithstanding the temporary pause in collections activities following the FCA's Borrowers in Financial Difficulty review. New business lending market share remained stable at 1.2% for the period, although the monthly market share in June was 1.5%. And prime lending grew as a proportion of overall lending balances to 38.1%, up 8.2% compared to the same period last year. In business finance, total lending was broadly stable as a result of a subdued market. Despite this, in our real estate finance business, net lending was 2.2% higher in the 6-month period. Lower new business volumes have been offset by increased retention and development of existing client relationships. We outlined many of the strengths of our real estate finance business at our recent capital markets event, and this, coupled with the positive sentiment we see returning to the market, means we expect to grow profitability in the second half of the year. The asset-based lending market has been quiet in the first half, which has kept new business lending at a low level. Net lending was 11.6% lower than at the end of 2023. Despite this, average balances for commercial finance were 4.7% higher than the first half of 2023. Customers are still feeling the impact of the economic headwinds, but thanks to our strong risk management controls, our risk-adjusted margin increased from 3.2% to 6.3%. We look forward to talking to you more about the strengths of our commercial finance business at a capital markets webinar, which will be held in November. I just wanted to say a few words about our savings capability, which is critical to support our lending activities. I've already mentioned that we achieved record deposits of £3 billion in the period, and during the first half of the year, we raised £700 million of new funds, but also retained £400 million. This has been achieved in part through a series of initiatives aimed at increasing self-service options for customers, which makes it easier for them to manage their accounts at a time and on a device that suits them. Looking ahead to the second half of 2024, we expect lending demand to increase now that the Bank of England has made the first base rate cut, with the market expecting further downward movement. We anticipate further improvement in our cost-income ratio as net lending balances grow and Project Fusion delivers further operational efficiency, and this will drive us towards achieving our medium-term targets. Our key priorities for the second half of the year will be to increase collections activity further, to reduce the inflated level of defaulted balances and provisions in vehicle finance, and continue our growth trajectory and deliver on our increased cost reduction activity. Hopefully that's given you an indication of the progress we've made during the first half of this year. Before I finish, I'd also like to welcome Jim Brown, who joined the board in March and took over as chairman in May. His many years' experience in the financial sector will be a huge asset to us moving forward. We do hope that you will join us later in the year for our next capital markets event, which will focus on our commercial finance business. In the meantime, if you'd like more detail on our performance during the first 6 months, please head over to our website. Thank you.